Have you heard this one? There's a pretty bold financial prediction making the rounds online, and it's pointing to a massive wealth transfer, one that's supposed to happen a lot sooner than you might think. It's a theory pushed by big names like Robert Kiyosaki, claiming we are right on the edge of a huge economic event. So today, we're going to break down what this is all about. And hey, if you find this kind of breakdown interesting, do me a favor and hit that like and subscribe button so you don't miss out on more.
Okay, so they're not pulling any punches here. This isn't just some talk about a small market correction or, a typical recession. The source material we're digging into from a channel called Ditta Finance calls this the greatest crash in world history. That is a huge, huge claim, and the whole theory behind it is built around a very specific timeline.
And that timeline pinpoints the year 2026. See, it's not some vague sometime in the near future kind of thing. No, it's a specific date where this theory claims all these major economic forces are finally going to collide. So the real question is, what's supposed to happen? And is there really anything you can do to prepare for it?
Now, this is where the mindset behind the prediction gets really interesting. The argument they make is that for people who are financially educated, a crash isn't a tragedy at all. It's a massive sale. A clearance event. This whole thing is framed as maybe the single greatest opportunity for a wealth transfer in our lifetime, where assets literally flow from the hands of panicked sellers into the hands of prepared buyers.
So, that brings us to the big question, right? Why 2026? What's so special about that year? Well, the theory is built on this concept it calls the everything bubble. Let's dive into the three big forces the source claims are about to smash into each other.
First, we got to get our heads around this term, the everything bubble. The idea is pretty simple, actually. Since the big financial crisis back in 2008, the entire global economy has been running on cheap money, super low interest rates, and just mountains of debt. And that, allegedly, has pushed the prices of, well, everything. Stocks, bonds, real estate, all up to crazy, unsustainable highs, all at the same time. According to the source, this bubble is all set to pop in 2026 because of three things coming together at once. First, something they call the debt maturity wall. Second, the end of the whole printing money era to fix problems. And finally, what the theory calls a forced system reset.
So let's talk about that debt maturity wall. The argument goes like this. Trillions of dollars in corporate and commercial real estate loans that were taken out when interest rates were practically zero are all coming due right around 2026. All that debt has to be refinanced, but at today's much, much higher rates. That can make them totally unaffordable for a lot of companies, leading to a wave of defaults. And that's expected to kick off a massive domino effect. The source uses this phrase, "the giants are falling," to describe what they see coming. A crash in both the stock and bond markets at the same time. And once those paper assets collapse, the theory goes that the last, biggest domino to fall will be the real estate market. But, this theory isn't just about predicting doom and gloom. It actually pivots pretty hard to a specific strategy it calls the Rich Dad Playbook. It's designed not just to help you survive a crash, but to actually profit from it in a big way. Let's see how that's supposed to work.
And this is really the heart of the message. If this prediction actually comes true and everybody is panicking, what do you do to be on the other side of that deal? Well, the source lays out a very specific three-step plan.
So the strategy is broken down into three main phases. Number one, build your opportunity fund. Number two, you identify the panic sellers. And number three, you master what's called the vulture buy. Let's break down what each of those actually means.
Okay, step one is all about cash, being liquid. The opportunity fund isn't a savings account for a rainy day. It's a war chest. The whole idea is to stack up cash now while the market's still high so that you have the capital ready to go, ready to deploy and buy up assets when, like the old saying goes, there is blood in the streets.
Step two requires a pretty big shift in how you think. You're not looking for your dream home here. According to this strategy, you're looking for distressed sellers. We're talking about people or companies that are being forced to sell their assets just to get cash and fast. Your goal is to solve their problem, their lack of cash, by taking that asset off their hands at a huge discount.
And that leads us to the final step. During a major crash, banks get scared. They often just stop lending money. The vulture buy strategy is all about being one of the very few people who actually has access to cash or private financing. By using your financial know-how and private partners, you can swoop in and buy those deeply discounted assets while everyone else is stuck on the sideline.
So why is this strategy so laser-focused on real estate? The main reason really comes down to a fundamental difference the source points out between two kinds of assets: real assets versus paper assets.
Just look at this comparison. On one side, you have paper assets, things like stocks and bonds. They're basically just a claim on something, and the source warns that they come with counterparty risk. That means you're trusting someone else to hold up their end of the bargain. In a big crash, that value can literally go to zero. But on the other side, you have a real, tangible asset, like a building. You can touch it, it fills a basic human need for shelter, and it can't just vanish into thin air.
And here's the key insight. While the price tag on a property might drop during a crash, its ability to make you money, to generate cash flow, can stay steady or even go up. The logic is pretty straightforward. As more people lose their homes to foreclosure, they have to live somewhere, right? They become renters. And that drives up demand in the rental market. This is how the strategy aims to build wealth, while the rest of the economy is in chaos.
So at the end of the day, this entire story is framed as a huge moment of choice. It presents this predicted 2026 crash not as some scary event that's bound to happen, but more like a fork in the road, where being prepared is everything. The source material closes out with this really powerful quote. It's all about emphasizing that if you wait until the crisis is already here, it's just too late. The whole argument is that the things you do now, building your knowledge, saving up capital, creating a network, that's what's going to decide the outcome for you as an investor.
And so we're left with this final, really provocative question. It just perfectly sums up the two sides of this predicted wealth transfer. According to this theory, in a great crash, you're either the one providing the cash or you're the one desperately looking for it. It's a really compelling, if not dramatic, way to look at things, and it for sure leaves you with a lot to think about.